Yo, welcome to the live stream here on YouTube. If you're listening on the podcast, welcome there as well. It is our weekly update, March 4th, 2023. We say weekly. I know some of you are like, you don't put it out every week. I realize that sometimes it's because there's not enough news to put out. There's not like exciting news or anything to report. And sometimes we just get extremely busy building out technology and all that type of stuff. So I apologize. We try to put it out weekly. That's why we call it our weekly update. But sometimes we can't get it out on time. We did this week because there is some good stuff to report, some good stuff about student loans, real estate market, stock market. So it's going to be a good update. If you're watching live on the stream, thank you very much. Share this with your friends, tell them to subscribe, like it. If you're watching on or listening on the podcast, subscribe to that as well. Share it. It helps us, it helps them. Everything on that. If you are watching this on the live stream, in the comment section, let us know how it's going, like what's going on with like your stock investments, like your 401k. How are you feeling about the financial world right now? Put it in the comments, let us know how everything's going. Starting off, we're going to start off with student loans. Not a lot of news here, just a lot of confusion. Okay, that's why I want to start off with this. And today, I've been asked because there's been news coming out over the last month, and it's really confusing about timeline. Like, when can I expect repayment to start? When can I do this? When can I do that? So I'm gonna go through and summarize for you a timeline so you can understand the possibilities of what could potentially happen over the next few months. Okay. First things first. People are asking, is repayment going to start in 2023 for student loans? This is the most confidence I've had that yes, they will be starting repayment this year, sometime this year. This is the most confidence I've had in that. Those of you that have been following our podcast and our videos, you guys have heard me say for a long time that as long as a Democrat was president, I felt that student loans would not restart. Okay. So when Biden became president, I said, hey, like I have an inkling that for 4 years, these things aren't going to restart. And as the months progressed, that thought and that reasoning progressed as well too. The reason why I'm saying this year, I have a stronger belief that they'll be starting is just because of all the news that's coming out. I feel like repayment is going to be starting, especially with the House of Representatives being majority Republican now. But I'm still like 1 foot in and 1 foot out on that. But I believe that they're going to start this year. If they don't start this year, they're probably not going to start next year either. So we'll see on that. But I think they're going to start this year. I think there's a low probability it's going to get pushed off to 2024, primarily because there's a lot of different bills coming due, not bills, but negotiation things coming in that Congress needs to show money coming in so they can spend money going out. And student loans are costing the government a lot of money. That's primarily the reason why I think they're going to kick them back in to get something done. We'll see. Timeline. Okay, that's what I wanted to touch on this. Okay, because there's a few things that throw like a wrench in all this stuff. Okay, so first, President Biden extended student loans, the repayment pause, and he said that he would not start student loan repayment until 60 days after the Supreme Court decided on the $10,000 in loan forgiveness. Okay, so that was the first announcement. So why is that important? That he came on most of the time with the Supreme Court, when they have this docket of cases, they don't actually come out with the decision until the end of the term, and the term ends in June. Okay. So even though they had hearings on it this week, a lot of experts that watch these things and stay on top of these things are predicting that they won't actually come up with a decision until June. And so if that's the case and they don't come up with it until June, so 60 days after that means July and then August. So repayment would start in August, but your first payment would not be due until September. Okay. So when he first made this announcement, that's what we were telling everybody: gear up to make payments no later than September. Okay, that was the first thing. Now, they could shock everybody. The Supreme Court could come out with a decision next week. Will they do that? I doubt it. We'll see what happens. So that's the first timeline, is by latest, we think that student loans are going to be starting in September. Okay, now there's a few other developments that have happened since then. Okay, the House of Representatives came out and said that they were going to put together a bill, which they did, and basically it was going to pass, that was going to end the COVID emergencies. The reason why that is such a big deal is that the only reason why the president has legal authority to keep extending this repayment pause is because of the COVID emergencies. Okay. And when they announced that they were going to do that, President Biden came out and off the cuff said, well, Republicans are quote unquote stupid because I'm going to end COVID forbearance, the emergency powers. I'm going to end that May 11th. And that's what he announced. And so the Republicans and the news picked up on that same day and basically published like student loans are entering repayment in May. And the reason why they're doing that is because at that point in time, there is no more emergency powers. And so if there's no more emergency powers, student loans kick in immediately. That's the way the actions were written, okay? And the laws were written from what I understand and what I've been told. And so that would mean that it's not going to be September 2023. It's going to be that you enter repayment in May and you start repayment in June, okay? And so that was that announcement. So all of a sudden that day was like, oh, we got to start gearing up because this stuff's coming out in June. But then literally the next day, the Biden administration was like, oh shit, like, what did we say? What did President Biden say? Okay. And they came out and said, oh, well, just because the COVID emergency is going to be over and declared over, that doesn't mean that we can't extend the repayment pause. And it's like everybody in Congress, even Democrats, lawyers that I know, they're like, we don't have a clue what they're talking about. Because the only reason why these can even be legally extended is because of that, the emergency powers granted because of the CARES Act and whatnot. So once that's declared over, how can you extend it? And they haven't explained it yet, but that kind of threw this whole wrench in everything because it's like, well, wait, are they just going to ignore the laws and say, well, we're just going to extend it? And then is it going to take a lawsuit from Congress to restart these things? Because if that's the case, that could bleed into 2024. So you see where the confusion starts coming in, right? With all these different things, and it's creating chaos in people's minds when it comes to repayment. So going back to our timeline, that threw a wrench in everything. And so the best we can say is that to be prepared basically for repayment to start in June, like your first payment being due in June, okay? That is the earliest that we think it's going to happen. The latest that it's going to happen is September. That's the timeline. So if you're building out your plan and you're trying to get on top of these things, that's when you have to start gearing up to saying, okay, I'm going to have to start making payments on my student loans in that time period. That is why we've been so adamant on people not waiting. Because I know a lot of you that we worked with have been like, well, student loans aren't in repayment yet, therefore I don't have to have a plan. It's like, don't wait. Like, now's the time to start looking into these things because they're going to be entering repayment soon. Okay. And then on top of that, you shouldn't be waiting either, because in your financial plan, you got other things going on, right? Like you got mortgages, car payments, credit cards, saving for retirement, all these other things. You don't have to wait. You should be gearing up for that. I'll give you an example. I just talked to somebody the other day. I actually talked to multiple people where their life has changed in the last 2 years. They have different events that came in. Some have been getting married. Some have had children. Some now have car debt, all these different things, and they still don't have a plan. It's like, well, you shouldn't be waiting for student loans to kick in to have a financial plan, right? As always, shameless plug. If you guys need help on that, that's what our technology is for, our FitBUX. It's $18.99 a month. You build out your financial plan, you get access to a financial coach and an expert that can help you build your plan and everything. So go sign up if you're listening to this, right? Shameless plug. But that is student loans. That's the timeline. So to clarify one more time, from a high level, the earliest we believe they're going to start repayment is June. The latest we believe they're going to start is in September. Okay. There's still that chance that we still believe that all this stuff will be chaotic. The Biden administration will then turn around and say, well, we weren't ready for repayment to start, and they can kick it off to 2024 or whatever it is. There's still that possibility. We don't think it's going to happen. We think it's going to be in that time period. Okay. So that is the first piece of news around student loans. We are going to dive into real estate right now because a lot has happened over the last month and a half. Okay. So we do like a quarterly update, different, just on real estate alone. And once a quarter or once every like 4 months, I'll come out, especially because housing as it's been going down. I'll come out and do what I call a back of the napkin valuation. So I believe it was about a month ago, 2 months ago, I updated that, right? Because mortgage rates had started coming down. And so for those of you that are familiar with that, you understood what I talked about. Those of you that haven't seen that or listened to that podcast or watched that video, basically what I do is I say, those of you that I don't know, my background is in valuation work. Okay. So that's why it's like, I call these things back of the napkin valuations, because instead of doing this like massive valuation and research, I look at things high level and say, what's a general area that I think it would be? And with real estate, I started doing this for myself because I was like, as housing prices plummet, I'm looking at potentially buying places. Okay. And so when this stuff all started with the interest rates declining, I said in my area, based on the peak of the housing market and the housing prices, based on that data that I was able to collect in terms of what people in the area could afford based on that interest rate, I changed the interest rate from like 3%, because that's what the mortgage rates were, up to 6.5%, because the affordability goes down drastically in that case. Okay. And based on the very first back of the napkin valuation I did, I said I would expect in my area that real estate would go down about 30%. Okay. And we went up a lot. So from a nationwide basis, it would probably be less than that, probably like 20%. I would say on average in most areas, 15-20%. But in our area, I live outside of Austin, Texas, it just skyrocketed in 3 years. It was ridiculous. So I said a 30% drop was warranted in my area. Now, that was the first one I did. I think it was back in like October of last year. I updated that back in the napkin valuation in January because interest rates on mortgage debt started to fall. And I said at that time that I thought that we should be looking at like 23% to 25% from the peak of the housing market. And at that time, we were down 17% in my area. And so I said, I'm going to start looking at potentially putting offers in, because even though we're only down 17%, let's just say that's like 650 or 650 grand or something. I can't remember the exact numbers. I could put in offers at 600,000, and that would represent like a 23 to 25% drop. I also said during that podcast that, based on economic things going forward that I was looking at, I thought there might be some more headwinds. So even though I was looking, I wasn't like gung ho, like, yeah, like we're doing this. Okay. But it was worth it to start looking. Now, that was from an investment standpoint. I also said, if you're looking to buy like as your primary house, you could have started putting offers in at that point in time and looking for places. Okay. Now, the reason why I want to talk about this on this update is because mortgage rates have gone right back up. Okay. They're upwards near 7% right now. So like when I did that podcast like a month and a half ago, they were like 6.25%, almost into 5%. And they went right back up to 7%. So affordability went down again. So I'm not going to show the entire back of the napkin valuation, but I ran it again this morning, and basically that drops it from the home price, like the peak. Now I would say a properly valued house would have to drop like 33 to 35% in my area based on that high of a mortgage rate, which means that housing prices in my area would have to be more around like 500 to $525,000 because they peaked out at like 750 on average to like 900, depending on the size of the house. So using that 750, it would have to drop down to like 500 grand. And currently right now, they're still selling for like 575. And I don't think that interest rates are going to drop dramatically anytime soon. I think they're going to keep going up or stay flat. So I think the affordability of housing is not looking good. I know a lot of you, when we did our end of the quarter last year, like our real estate stuff, we were talking about, me and Josh over at Neo Home Loans have been talking about, we believe a recession's coming, which we believe it is, and that interest rates are going to be dropping at the end of 2023. I'm not so confident on that right now because of some of the news that's come out over the last month or two, that I could still see the recession hitting in 2023 pretty hard and rates potentially dropping, but it might be more of 2024 time period because of what's going on with inflation. Those of you that don't know, the inflation numbers were not good in January and February. Okay. And so everybody got excited in January. Actually, I should say this last month wasn't good. Everybody was excited because we had 1 month where inflation went down and then it went right back up. All right. So not good. And instead of 2 interest rate hikes from the Fed, which is the Federal Reserve, now people are actually starting to say it's going to be 3 more interest rate hikes. The good news on that is that if you have cash and savings in the bank, you might be able to earn like 5 to 6% on it pretty soon. So if you're a saver, it's awesome for us, right? But if you're trying to buy a house, it's going to be expensive. And again, I don't like saying, I want to clarify something on that. I don't like saying it's expensive because of an interest rate. That's not necessarily why it's expensive, right? Because if a house was 100 grand and the interest rate was 7%, you could still afford it. So it's expensive because affordability is low, because housing prices are still too high relative to incomes. That's why. Not only that, but because of what's happened with inflation, with like cost of food and utilities and everything else, it's expensive as hell right now out there, when that's not going to drop either anytime soon, because deflation is not going to be a thing. I mean, once we get this down to a 2%, month over month increase or year over year increase in inflation, we're good. They have no interest in deflating anything. And so these prices, in my opinion, for food and utilities and everything, they're here to stay. They may drop a little bit, but relative to what they were prior to the inflation, like the last few years, they're not going back down to that previous spot. So something that used to cost, for example, $2, that's now costing $4. It might go down to like $3.50, but it's not going back down to $2 anytime soon. Okay. So that is the real estate stuff. Affordability in the last like 3 or 4 weeks completely turned back around to unaffordable. And I think, again, housing is going to take a further dip. Again, in my area, we're already seeing it. I don't know about your area, but if you're looking to buy a house, I would potentially be like, okay, maybe I could put in offers at even lower prices, because real estate's not moving right now. Okay. Stock market. Same thing I've been saying for the last 6 months. It's all over the place. And, all the indicators out there are saying that it should go down, except for like one, which is unemployment. But everything else is basically saying that the market should be going down based on just things that I've been looking at. Bottom line is over the next probably, I would say 9 months, you're going to see the market doing this up and down and up and down and up and down. Okay. And I'll give you an example. Since the beginning of the year, the stock market from January 1st to today is actually up 5.75%. But if you look at it from the high, it's down 3.21%. Okay. And if you actually took away Friday, because Friday the stock market did like, and the S&P 500 is what I'm referring to for the stock market, it went up like 1.6%. So if you actually factor that down, the high, we're up 5.75%, but from the high, it would be down like something like 4.8% if it wasn't for Friday. Okay. So it's like all up and down and up and down. That's called volatility, is what we call that in the finance world. Okay. I expect more of that And the reason why I want to bring that up is because a few of you have asked me what I'm referring to in terms of dollar cost averaging when I put out the weekly reports in the past. Okay. And I'll do a write-up on a blog and whatnot, just describing dollar cost averaging. But with dollar cost averaging, the theory behind it is that you keep putting money into the market no matter where it's at, the ups and the downs, ups and the downs, ups and the downs, because eventually over time it will trend upwards. Okay, that's the theory. And that if you're investing it all along those curves, then even at the down spots, you're investing. So as it's going up, you're making money on that. So like if I put in $100 last week and then the market goes down to say, and I bought it for like $1 a share and it goes down to like 50 cents a share, then I basically went from $100 to $500 or $50. I'm sorry, $100 down to $50. Okay. So it's like, oh man, I just lost 50%. But let's just say I put another $100 in there at 50 cents a share. And then the next week it goes back up to 100. Well, on my original money, I'm then breaking even. But on the money I put in the week previously, I just basically upped that to $200. So net, I'm up money, even though the market's back to break even. That's how dollar cost averaging works. And it's over time, research has proven that it does work and it reduces the risk. That is why things like 401ks work, is it builds that discipline because it's coming out of your paycheck, for example, every 2 weeks and it's going into the market. So it's constantly investing into it. Okay. That's why actually somebody asked me about some of these trading apps and like even our hybrid robo advisor where we partner with Betterment. And they asked me like, how frequently should I do it? Should I put money into the market like my Roth IRA? Should I do it once a year, once a month, every 2 weeks? Technically, from a dollar cost averaging standpoint, it actually makes sense to do it every day. And that's one of the cool things about technology is you can do it every day now. Like instead of saying, hey, look, I'm going to do $30 a month into my Roth IRA, you can literally do like $1 a day and you're literally investing all along the curve. Now, does it make sense to do that? No, because then you got to start buying fractional shares and all that type of stuff. But technically, because of technology, you can do it. But every 2 weeks, you should be fine. As if that money's coming out of your paycheck or once a month, it should be okay. So that's my recommendation of that. Keep dollar cost averaging into like your Roth IRAs and whatnot. If you want to try to time the market, now you're talking about investing, not money management. And if you're going to start investing, you got to, it's a full-time job. So you got to get on top of it and start doing some stuff there. So that's the weekly update. I hope you guys enjoyed it. Like I said, it's a lot of good stuff. The timeline with student loans, to just recap that, plan on making payments sometime starting between June and September of this year. Got to gear up for it. Don't wait. Okay. Don't wait. It's coming. Real estate affordability took a massive hit over the last few weeks. So I expect that to continue. And then with the stock market, keep on dollar cost averaging and you should be good to go. As always, if you guys got any questions or if you need help with your financial plan, make sure that you contact us at FitBUX. It's $18.99 a month for our financial planning technology. You get access to a coach. We look forward to talking to each one of you soon, and you guys have a good